Thank you, Larry. Thank you, Jeff. Good afternoon, everyone. As you are all now well aware, mental stability is not a prerequisite to expertise within the hospitality arena. In fact, it has been frequently stated, and I have often heard from clients, that you have to be a little crazy to actually want to get into the hotel real estate world. Notwithstanding the usual challenges of development with construction costs, city councils, and lender requirements, a hotel owner has to wrap their thinking around this fact. A hotel involves several hundred lease transactions per night. Ultimately, hotel operators have to focus their resources on everything that motivates a customer to make a yes decision in about 45 seconds. This, it may surprise you, is not as easy as it may seem. However, when it comes to the yes factor, the Twin Cities is changing in a dramatic way. First, let's talk about what we witnessed in the Twin Cities in 2007. As you can see in this chart, total hotel revenue increased 7%. Occupancy, however, did not follow this trend. It came in at 67.5% through November. This represents a gain of only 0.5%. This occurred while the number of available room nights over the course of the year increased by roughly 260,000. Digging deeper, we see that the average daily rate increased only $4.75, which is a 30% decrease in growth compared to the previous 2 years. Another measure, revenue per available room, increased almost $4. This is equal to the gain in 2006. So, what does this tell us? This tells us that hotels are still growing revenue, although more slowly than in previous years. It also tells us that new construction is at a pace roughly equal to the growth in room demand. So what about the changing landscape in the core hotel clusters? In a word, upscale. Minneapolis is witnessing the largest lodging expansion in its history. With the recent opening of the Chambers in Weston and the scheduled opening of the Aloft, Fauché W, Minneapolis Hotel or Doubletree, and the Ivy, Minneapolis will have completed its transformation into a first-tier market. More importantly, the quality and rate class of these new rooms demonstrates a significant increase in the willingness of the customer to spend more, and here's the part that is music to the hotel owner's ears: spend it more often. Not only is there an expansion into new upscale products, there is also a significant upgrade underway of existing hotels. With several major properties changing ownership, large renovation projects began that will significantly upgrade overall product quality. The interesting aspect of this growth is that the greater part of it is driven by the large number of women who have entered the corporate traveling workforce. This has occurred to such a degree that it has changed everything from the amenity packages provided in new hotels to the architecture of newly built properties. Its influence is now so great that increasing numbers of corporations have raised the minimum lodging standards requirement for their employees to protect their investment in personnel. And this is where we come back to the yes factor that I spoke of a few minutes ago. The corporate and leisure traveler have significantly changed their expectation of lodging amenities. They have changed this expectation to include a secure environment, flat panel TVs, hot food, triple sheet bedding, pillow top mattresses, and service, service, service. I think you get the idea. The investments that have been made in both new construction and renovations are the result of a greater willingness on the part of the customer to exchange more dollars for location and amenities. In addition, just as this floor has been raised by the customer, the ability of the hotelier to understand his or her customer and their travel patterns has increased significantly. While the current investment boom in hotels in the Twin Cities is part of a pattern that has occurred throughout the U.S., it has occurred to a much larger degree in our downtown market than elsewhere. In part, this is a result of the Twin Cities being behind other similar major markets when it came to the number of upscale hotels located in the downtown districts. In many cases, The existing product had run its course during the 90s and was showing its age. As a result, we are witnessing the opening and continued development of major high-end products in this market. And this includes franchised hotels as well as boutique hotels. The major franchise companies, having invested extensively in customer research, are firing on all cylinders. They know their customer, they know where they come from, and they know what they want. So, what does all this mean? It means that hoteliers, using a variety of tools, have improved yield management dramatically. It means that customers have raised the bar regarding what they are willing to spend for a night's lodging and have pushed the envelope of rate and occupancy in the upscale markets. It means that the Twin Cities market is going to continue to see revenue growth among the upscale limited service and luxury brands. So, what about the future? The one guarantee I can make for 2008 is that I will not be filmed jumping on a bed anywhere. It is the case in today's economic environment that any conversation about commercial real estate quickly turns to recession and the turmoil in the credit markets. So far, the hospitality lending markets have continued to proceed, although with higher costs and much more risk analysis. The turmoil has removed dollars from the leisure travel segment, and this is impacting some areas of the country with significantly lower occupancies. Florida and California are good examples. We have not witnessed this in Minnesota to any large degree. It does not appear yet that the higher cost of transportation fuels has severely reduced travel in Minnesota, and for that matter, it may help our area as people will choose to spend their dollars closer to home. This does bring us to a very important item, and it is the effect of the devalued dollar, and I cannot stress this enough. The Twin Cities community does not view itself as a strong gateway city for foreign travelers. With the Northwest Airlines hub, the Mall of America, and an overall perception of Minnesota as a safe community, the Twin Cities is well positioned to take advantage of the euros, yen, and other foreign currencies that will appear. The LRT and its connecting of the airport, mall, and downtown core is a familiar and comfortable device for travelers from Europe and Asia. To foreign travelers, it makes Minnesota accessible and modern. The LRT will be the rail that brings those euros and yen downtown. As an operator, if you do not have exposure in those markets, get it, it is going to be huge. So, where do we see growth? Where are the new opportunities? Well, here they are. Buy into the upscale luxury, focus service, high-end limited service, and mid-scale limited service hotels. They are going to generate profits as customers continue to migrate to these brands. Sell the older budget and economy hotels. They are going to continue to see erosion in revenue. And wait, please wait before you buy a water park hotel. You need to talk to us. Even through a recession, if that is where we are, the long-term change in travelers' expectations will not diminish. As the travel volume ebbs and flows, customers are still going to remain attached to the quality they have become accustomed to, and that is where they will spend their lodging dollars in the future. So this concludes my review, and I'll be giving autographs in the reception area after the show. Thank you.